I'm curious about how markets digest new products, new innovation, news, and whether they do it efficiently or inefficiently, and ultimately the cost to investors. Hi, I'm Shaun Davies. I'm a finance professor at the Lead School of Business at the University of Colorado Boulder and faculty director of the Burge Center for Finance.
I'm very happy that, I can get your opinion about many things because it seems to be a particularly erratic moment in time in history. Has there ever been another time like this?
I live and breathe markets. If I'm not doing research and I'm not teaching, I'm reading the Wall Street Journal and watching the news. I would say this actually is not that chaotic of a time, at least based on market metrics. A year ago, when we were going through Liberation Day with the announcement of all the new tariffs or potential tariffs, I should say, a lot of those got refined, let's say. Um, it was much more volatile than it currently is. Now, the headlines are incredibly volatile. I mean, it depends on what day people are listening to this in terms of what they're thinking about what's going on in the Middle East. We live and die by tweets right now. So the news cycle is certainly incredibly volatile, but markets themselves have not been incredibly volatile. Yes, there's been a lot of up movements in certain prices, down movements in prices, but if you look at it, here we are, middle to late April, and markets in the United States actually are up almost 7% this month.
With all of the news and with kind of very extreme news that's back and forth and back and forth, the markets aren't really being affected by that. Is that what you're saying?
Like the levels of price swings that we've seen, the highs to the lows, back to the highs, they're not unprecedented by any means. I mean, we've seen this. We saw this both, last year with Liberation Day and the announcement of tariffs. We saw even more extreme movements when inflation in 2022 was, the talk of the town. During COVID, I mean, COVID, we were seeing daily swings up 10%, down percent. And so if we just look at it in the historical context, this is not unprecedented. And when I say historical context, I'm talking about the last 10 years, not the past 100 years in which, again, we'd see way more episodes that were incredibly more volatile than what we're seeing right now.
Do you think that people have the impression that markets are very erratic right now?
I think if you're following news headlines, particularly on geopolitics, you probably feel like the markets are incredibly volatile. I mean, for example, I have a news feed on X. Most days I'll see, 25 new notifications over a few hours. Right now it's like 125 over an hour. And so just the constant back and forth, oh, things are going well, things are going poorly. Oh, this country's concerned about this. Oh, we've got, issues perhaps with supply chain and fertilizer costs and things that will affect agriculture. And so when you look at the news feed, the headlines are incredibly volatile and both positive and negative. And depending when you check, you might think things are being resolved, or you might think we're getting into a deeper conflict. And so on the news side, incredibly volatile. But then if we turn our attention to the markets, not that volatile in terms of the stocks and bond market. I mean, there are up and down days, but not unprecedented volatility by any means. Now, I will say there are parts of the market that are incredibly volatile. So if we look at the commodity space, whether you're looking at oil's been incredibly volatile, moving 10, 15% a week in one direction or the other. So oil has been incredibly volatile, as well as, some precious metals like gold and silver, also incredibly volatile. But when people look at things like their 401k portfolios, which are primarily stocks and bonds, yeah, they're seeing movements, but not uncommon during episodes of uncertainty.
What in the past and historically has really made markets very volatile?
There's a few things that can really set the market up for risk. One is uncertainty about cost of capital because, cost of capital affects everything from the borrowing rate for mortgages, credit cards, especially for corporations in terms of planning real investment and undertaking projects. And the cost of capital ultimately determines whether or not something is worthwhile, something we'd call positive net present value, or if it's not worthwhile, negative net present value. And that cost of capital is huge determinant of whether or not something's worth pursuing. And so when we see things like inflation spiking, that feeds into firms' cost of capital. And if inflation is spiking and, interest rates are going up, they're going to be reluctant to put shovels in the ground and engage in real investment. And that can be really bad for markets. The other thing that really can disrupt markets is concerns about the finance system, like the banking system. You go back to the great financial crisis. We had a lot of concerns about financial institutions and their health, as well as the plumbing of the financial system. And so anytime we get either concerns about cost of capital or the ecosystem of how capital is moved around, for example, through intermediaries like banks, that can really concern folks.
And do you foresee those issues being of concern to the markets in the near future?
So obviously we've got concerns right now with inflation ticking up as oil prices go up, right? Oil prices don't just hit us when we go to the gas station and get gasoline. Every product that we purchase at a store, it's shipped there. And typically, on a semi truck that uses diesel. And so if costs of transportation go up or jet fuel goes up, that's going to feed back into prices. And so while inflation has been coming down, it's still above the Fed's target of 2%. And this sort of throws, a little wrinkle in the plan because we could see this feed back into prices and cause prices to go back up and accelerate, and we could see another episode of higher inflation. It also feeds into goods. Like a lot of folks maybe haven't fully appreciated how this will affect the cost of fertilizer, which obviously is a huge input into agriculture. And so if that goes up, then, both feeding livestock as well as produce, everything would go up in price. So that's one concern is the inflation channel. The other one is not Iran related. And it's actually taken a little bit of a back seat to the whole Iran Middle East tension, which is concerns about private credit. And I'm happy to go down that rabbit hole with you if you'd like.
Yes, please.
Private credit is kind of like private equity. It's very similar, where you have a managed fund that makes loans to companies. Okay, so private equity, they buy equity in companies. Private credit, they're making loans to companies. And this is different than banks because these private credit facilities, they are not under the same regulatory requirements that banks are. And so they can lend to or companies that might not have access through traditional banking channels. And the goal, obviously, with private credit is to make loans, get a good return, and then return of investment with that good return back to the limited partners in the fund. We've seen private credit explode in popularity. It's over a $2 trillion industry now. So lots of money in private credit, which is great as long as people can pay off those loans, make their interest payments and pay back the principal. What we're starting to see is cracks in the system. And I'll give you a few examples. So, the topic du jour on any news channel or any classroom at a university is artificial intelligence, AI. And so when, new versions of Claude have come out, the market looks at them and they're like, oh my gosh, this is going to replace a lot of software companies. And particularly like a lot of enterprise software companies, B2B software. And unfortunately, a lot of the loans made in the private credit sphere have been to software companies. And so now you get concerned about their ability to service those loans or that debt. And so we started seeing some cracks in the system, and we're starting to see, delinquencies and some concerns that people will not be able to pay back these loans. And unfortunately, a lot of this private credit is in these investment vehicles like evergreen funds or interval funds, which are called semi-liquid funds. And so the reason they're semi-liquid is you might be able as an investor that if you've invested in one of these evergreen or interval funds, you might be able to get liquidity, meaning get some of your money back at a quarterly frequency. And what we've seen is a long line of people asking for their money back out of these funds. And these private credit funds have had to effectively close the gate, right? In the fund, they might say, we're only going to allow redemptions of 5% of the fund's assets in a given quarter. And people are asking for 15. So, folks are getting rationed. That obviously causes, fire sales, right? They know that there's more demand for people to exit the fund, so they're going to have to sell some of these loans to other people in the secondary market, and probably at prices below fair value, and so that can generate externalities as well. And it's very early, but we just don't know who has exposure yet, right? If some of these private credit loans default, like who's holding the bag outside of the private credit funds themselves? Where else is there leverage in the system? Are there, guaranteed lines of credit that are going to be drawn down, and suddenly now some banks have exposure? There's also, exposure perhaps through derivative securities. So both J.P. Morgan, Chase, and Morgan Stanley have recently announced that they're going to be trading or allow clients to trade derivative securities on private credit through something called a credit default swap. And effectively, a credit default swap is a way to bet against private credit or bet on private credit. But anytime you have a derivative security, essentially that derivative security increases the market's exposure to that asset class. And we've seen this play out before. We saw it in the 2008, 2009 financial crisis. Yes, we had a residential mortgage crisis, but the reason that it was so big was because of the derivative securities out there chasing these asset-backed securities, these subprime-backed mortgages. And so we don't know yet. We're in the first innings, or first or second inning of this game. We can look back at the 2008 financial crisis and figure everything out because we've got 18 years of history of where we've been able to figure out where all the skeletons were buried. Right now, we don't know. And so I think folks need to just watch private credit, especially because, the Department of Labor has made it easier for retirement plans to put access to private credit funds in your, 401k. And so, you get a little nervous when, private assets that historically have been only available to institutional investors and high net worth individuals, when suddenly they're available to the common person. You worry, why? Why are all of a sudden they come allowing this?
So news-wise, we distribute research in all areas. And so we are not, and I am definitely not an expert in any particular area, but it's fascinating and it helps me then to not know necessarily deeply about anyone's field so that maybe I can ask those questions for more people to understand it. But, with finance, I understand kind of basics of finance. But when I was reading about you and what you do and where your focus is, like asset management, I kind of don't realize. I mean, I know what the words mean, but I don't really know what that means.
When I talk about asset management in terms of my research interests, it's really thinking about delegated asset management. So when people delegate their portfolios to professionals, and so particularly interested in exchange traded funds, which are taking over the markets. We live in a benchmark driven world. There's a big movement from people investing in actively managed funds and moving instead to a passively managed ETF. And as more and more people move into these ETFs where you're just buying the benchmark, that can have real implications for markets and asset prices, volatilities or uncertainty. And so that's a big segment of my research. The other segment of that asset management research relates to target date funds, which are by far the most popular investment vehicle for U.S. households. Uh, Basically, in Pension Protection Act of 2006 under President George W. Bush, these target date funds were classified as qualified default investments, QDIs. And so, if one of my students here at the University of Colorado graduates and starts a new job and they get auto enrolled into their firm's 401k, the default investment will be a target date fund. And these target date funds are a great innovation, right? So what they provide is, when you're early on in your career and you've got a lot of years to retirement, they're going to invest a lot in riskier assets like stocks. And as you get closer to your target date, your retirement date, that portfolio is going to rebalance and hold more bonds and less stocks. And so you have a safer portfolio at retirement and through retirement. And so it's a great innovation. Uh, the issue is that there's massive heterogeneity in terms of quality of target date funds, fee structures, asset class exposures. And so trying to shed light on a great product, but with a lot of opaqueness to it.
It seems like through the media and social media, there's been more education about investing in the S&P 500, like Warren Buffett's mantra almost, right? Like, don't try to play the game of one stock or the other, but invest in the overall market.
There's a famous academic named Bill Sharp. And so if you've ever taken a finance course or done an MBA, you've probably heard of a Sharp ratio. That's attributed to Bill Sharp. But another idea that Bill Sharp presented was something called the arithmetic of active management. The average investor, just by math, must be holding the market portfolio. The only way someone can beat the market portfolio, say the S&P 500, is if someone else underperforms. For every winner, there's got to be a loser. And so you can essentially guarantee that you don't lose, that you meet the market by just holding the market. And so this idea of the arithmetic of active management, obviously solidified by Jack Bogle at Vanguard and, the mantra of investing in low cost index funds that just provide the benchmark. You can guarantee yourself the benchmark's return, not worry about beating it or losing to it, has really gained momentum. And, folks are moving away from actively managed mutual funds because when you look at actively managed mutual funds performance, before fees, yeah, maybe a few beat the market. At best, they equal the market. And then once you account that they have higher fees, on average, investors lose. And they'd be better off just holding a low-cost index fund.
What would you be worried or what would you advise people and investors or individuals against doing in this short-term period of news volatility?
One, the market is so much quicker and so much smarter than any of us are individually. And so, you might see a headline and think you understand it really well and take a position, and maybe you're right, right? Maybe you get it right and it outperforms. But on average, trading on news, you just can't expect to be smarter than the market. And so I get concerned about people, almost like day trading in their 401ks and things like that are set up to be savings for retirement. You're at the mercy of one tweet, completely blowing up the position you just took. So buy and hold long-term investor. If you've parked a little bit of money in sort of a fun account and you want to dabble and you're okay, in the same way that maybe you put a few $100 in your wallet before you go to Vegas. Yeah, sure. Do that. But we're talking about your retirement portfolio. Don't trade it. And if you think you're susceptible to behavioral biases, we all are, right? We know of all these behavioral biases like overconfidence and things like that. We are exposed to them. If you're worried you're going to succumb to them, seek out professional financial advice, right? Financial planners, especially if they're CFP and they're fiduciary, they really are money doctors, right? Maybe you know a ton about finance. Maybe you know more about finance than them, but they are going to help you overcome these behavioral biases and not make bad decisions.
Very good point. Just because being so close to the topic, having it be your money, it doesn't give you the ability to get away from those biases. I guess that's what you're saying. And it's so clear and true. And why don't people really more often understand that?
Imagine you had sold your portfolio and when, all bonds are all cash in like January of 2009, right? The world was collapsing as we all thought it was in the moment. Like we thought we had no idea what we were on the brink of. And if you had, liquidated everything at the beginning of 2009, you would have missed one of the best bull runs this country has ever seen and really been living in regret. So it's just the adage of be a long-term investor, buy and hold. That is probably the best advice for 99% of people.
For individuals, let's say for their 401k plans, it seems like it can be pretty complex. There are names that aren't really understood what they're made of. How do people figure out what is the best thing or if those funds are made up of private credit companies? Like it seems like it's not maybe not very obvious.
Yeah, so if you think about your average 401k investor, they're beholden typically to a menu of pre-selected choices. They don't have access to the full market. And so if, any of your listeners go on and look in their 401k, they probably have got like 30 choices of funds that they can invest in. Most likely, like 10 of them will be target date funds, with different target dates, like a 2025 fund, a 2030, a 2035 fund, and so on. And you're kind of beholden to the menu you have. Folks will maybe switch around across that menu, but there's a lot of empirical evidence that most households suffer from inertia. So whatever you're originally invested in, that's typically what you continue to hold. Moreover, we know that people interpret defaults. Okay, so like for example, target date fund is now the default investment. A lot of people interpret defaults as advice. And so they're just really reluctant to move around in their menu and pay attention to it. A lot of people just don't pay attention to what they're in, which can be good. Okay, that can be good, right? Because during times of volatile markets, maybe they're not over trading and doing things that are detrimental to their wealth. So that could be good. But at the same time, maybe they're not in the best products, or maybe they're in high cost products and they could get equivalent risk exposure in a much lower cost fund. And so there's trade offs with that. As far as private credit goes, you'd probably see it deployed within a target date fund. So the target date fund structure is a fund to fund structure. So you invest in the target date fund and then the fund invests in funds beneath it. And so most likely if we start seeing 401k access to things like private credit or other private assets, my guess is that it would come through a vehicle like a target date fund, and that actually wouldn't be on the menu itself as an individual choice. It would just be in this bundled good of the target date fund.
Are there any kind of new forms of capital? Is there something that's coming out now or has recently come out that you think is gaining traction and is a good thing, or it looks effective or looks safer than other options in some way?
Safer is always hard. I will say there are new developments, right? So, the big changes that are coming, one is obviously crypto. The blockchain is pretty amazing. If we can tokenize things, that's going to allow for greater liquidity, easy transfer of ownership from one owner to another. You can also do fractional ownership. So when we think about, things that have historically been difficult to trade, for example, private equity, private credit, tokenization could revolutionize that. I'm not going to, weigh in on the merits of cryptocurrencies. That would be a topic for a different day. But there's definitely pros and cons in those markets, decentralization, but also massive amounts of manipulation. So there's that element. The other one that's really gaining traction is these prediction markets, where you can open a prediction on anything from, what is the first song going to be played at the Super Bowl halftime show, to what is the S&P going to do at the end of the week. And so these prediction markets, massively growing, decentralized, right? You can just do it on the internet. You don't have to go through an intermediary. I mean, I guess the platform is kind of an intermediary, but it's very decentralized. And we're seeing, them used in the financial system. Um, Now, that's good, right? You're giving people new abilities to hedge risk, right? It's allowing people to say, put something on the prediction market and hedge themselves elsewhere. And so there's a nice hedging element to that. But there's also concerns about speculation, right? It can also be used to speculate on things. And also there's concerns about insider trading, right? We've been reading articles in the Wall Street Journal, New York Times about people making really large bets ahead of geopolitical things. And so there's a concern too about just the fairness of those markets. And, obviously regulators should probably pay attention. We live in a world where regulators step in only after things go poorly. So those are two things I'm watching: prediction markets and blockchain.
The prediction markets, at least to me, and they seem more like a betting venue almost, right?
They primarily are a betting unit at this point, but we are seeing, some financial institutions utilizing them for hedging purposes. So they are primarily a betting mechanism. But I would argue a lot of people on Robinhood are also using financial markets as a casino.
What would you say that the future of finance looks like?
Well, if I could tell you what the future of finance looked like, I probably wouldn't be a finance professor. I'd be running some private hedge fund. But I think the future of finance, look, at the end of the day, we need capital to go to companies. And, new ideas need capital to hit the ground running. And so providing capital will always be there. Now, how it's provided, how it's intermediated, that I don't know, right? Will we see, more fintech, displacing historic institutions that had provided capital like banks or, more sophisticated things like venture capital and things like that? I don't know. But at the end of the day, one truism is that we have to have a system to move capital to its best use. And the finance system generally does a good job at that. Obviously, there are issues. We've got issues with charlatans out there. We've got issues with market frictions. But generally, we like to think that the financial system deploys capital to its most effective use. And that will never go away. But how it's deployed, how it's intermediated, how it's evaluated, how it's benchmarked, um, time will tell, but it will be a disruption, right? We are certainly at the beginning of something that we don't know. And it's probably a lot of the same emotions people had in the late 1990s with what is the internet going to do? And look what it did. I mean, it massively changed how people bank, how people save for retirement, how they get information. And so we don't know what it's going to look like, but people will still need to deploy and receive capital.
Thank you so much. First of all, I wasn't expecting your response, and also knowing better about really what is the volatility of the market, that it's not as high or as bad as what maybe is perceived. So I was really helpful in then to understand the private credit aspect, and all of your perspectives are so nice to hear.
Curious by Nature is a production of Newswise. More than 7,000 journalists get the Newswise wires. Visit newswise.com and find out how to spread your news today.